Okay, well, hello everybody. This is Dr. Sam Lansafame once again. Today we're going to be talking about the journal entries that are involved when you have a small stock dividend versus a large stock dividend, and we'll also see the impact on the stockholders' equity section of the balance sheet. So a couple of quick comments here. If you just got done watching my previous video, you probably remember me talking about what's the difference between a large and a small stock dividend. Well, if you look over to the left of the screen, you see that I have in yellow a small stock dividend is typically somewhere less than 25%. So usually sometimes you might see a range 20 to 25%, but let's just keep it simple. And we'll say less than 25% is a small stock dividend. And when you have a small stock dividend, you are required to use the market value. So therefore, when you use the market value of the stock, there's like a 99.9% chance that the market is going to be higher than the par that was originally established for the stock. So therefore, you're going to need to use the PIK account. So as you can see here to the right in yellow under columns J, K, and L, you see I have the stockholders equity impact. So common stock is going to go up along with the PIK account, and then retained earnings will decrease. So when you have a small stock dividend, you will have to use the market value. So we'll put in here must use market value to determine the debit to retained earnings, or if you aren't using retained earnings, your stock dividends account, your stock dividends declared. Okay, but I want to point out, I'm going to put this in blue here, and the reason I'm putting it in blue is I have a little note here to the right, and it says journal entries are assuming that instead of stock dividends declared being closed into retained earnings, we are using retained earnings immediately, eliminating the need for the fourth closing entry. I talked about this in the previous video. If I were to use stock dividends declared in the journal entries I'm about to show you, that's assuming that I would eventually close it into retained earnings. So we're basically eliminating the middleman. So instead of creating stock dividends only to close it into retained earnings, we'll just use retained earnings right out of the chute. So it's kind of considered like a shortcut approach. Okay. And just one other comment here, when we do large stock dividends, you have to use the par value, not the market value. And I'll just keep it simple for the debit. Okay, so I'll put that in blue as well. So when we're in a small stock dividend scenario, we got to use market value to figure out the debit to retain earnings. When we are in a large dividend scenario, 25% or greater, we use the par value, not the market value, to determine the debit. Okay, so notice the stockholders' equity impact. PIK is not impacted at all because if you're using par, then your par and your par is going to make your debits equal your credits. Whereas if you're using a small stock dividend and you're using market value, your market will be higher than the par, causing a need for an entry that, or a transaction account or a GL account that will cover the difference between the par and the market. And that's where the PIK is going to come into play. But notice in both cases, your stock account's going up and your retained earnings account is going down. So that's important to take note of. So I've created a little pre-problem here for us to work on. And if you notice the data, Vroom Corporation had a $600,000 balance in retained earnings. Vroom Corp declares a 15% stock dividend on its 100,000 shares outstanding of $5 par common stock. The current market price of its stock is currently $20 a share. Okay, so the thing that we want to point out first off is we need to know if we're doing a large stock dividend or a small stock dividend. So the fact that, as you can see here, we've got 15%, this whole declares a 15% stock dividend right then and there it tells us that we are in a small stock dividend situation. So let's just put up here, small stock dividend. So that's what told us it was small, because it was under 25%. Okay, so that's clue number one. Next thing we need to do is we need to do some math. And we need to figure out how many shares is the company actually giving to its stockholders. So there's currently 100,000 shares outstanding in actuality. So that means only the people that actually have the stock in their hands are eligible for a stock dividend. So we're pretending in our example that there's 100,000 shares outstanding, and the par value of this common stock is $5. So question number two, now that we know we're supposed to, this is a small stock dividend, the second question is, do I use the market price or do I ignore it? And if you remember from just a few minutes ago, I mentioned that if you have a small stock dividend, you must use the market value to determine the debit. Okay, so here's some math that we're going to do. Let's put a box around this here so that you don't confuse the math with part of this box. Okay, so math involved. Can't spell again. There we go. So the math involved is you first have to calculate how many shares are going to be in the possession of the stockholders once you give and declare this dividend. So what you have to do is you have to take how many shares are currently in possession of the stockholders, so 100,000 shares, and we're going to give them a 15% dividend. So nothing fancy. We're just going to take 100,000 times 15%, and that's going to give us 15,000 shares. So 15,000 shares, extra shares, are going into the pockets of these stockholders. So pretend you own all 100,000. After the company declares this 15% stock dividend, you now have an extra 15,000. So you're going to have 115,000 shares. Not a bad deal. Okay. All right, so that's part of the math. The next thing we want to do, the math is basically two steps. Now that we've got the 15,000 shares, I want to do some math with the 15,000. So to calculate the debit to retained earnings, so we'll just put here retained earnings. What we need to do is take the 15,000 shares that the stockholders are receiving, and we're going to multiply that by the market price. So if we do 15,000 times $20 a share, try to do that math here real quick. Anybody know what it is? Let's figure it out. So if you go 15,000 shares multiplied by 20, you come up with 300,000. Okay, so that's $300,000. Let's put that with a dollar sign. So I took the 15,000 shares and I multiplied it by $20 a share, because that's the market price. I also need to figure out my stock value, and I'm going to take the 15,000 and I'm going to multiply it by the par value, and the par value is $5 a share. So do that math. 15,000 times 5, probably got 75,000, right? Okay, me too. So now we've got 75,000 representing the base value of the stock. And notice that there's a difference between the 300 and the 17, or excuse me, and the 75. So that's going to involve our pick in excess of par because the par value is 75,000 and the retained earnings is going in at 300,000. So we're going to have excess, and we're going to take that 15,000 one more time, and we're going to multiply it by the difference between the 20 and the 15, which is the 20 and the 5, excuse me, which is 15. And let's do that math. So we got 15,000 multiplied by 15, and we've got 225,000. Okay, so these are the numbers that are going to go in our journal entries. So comes time for journal entry. Journal entry number 1, which is the stock dividend declared entry. Okay, you ready for this? First thing we're going to do is we're going to debit retained earnings. You could have debited stock dividends declared, but remember my earlier note, I'm making the assumption that we're not doing the fourth closing entry, so we're going to use retained earnings right out of the bat, or right out of the chute. And we're going to debit retained earnings for $300,000. You then want to credit the stock account. Now, whenever we have credited the stock account, we've always credited it at par, and we're still going to do the same thing. So we're going to credit common stock. However, we haven't actually given them the stock yet. We're promising to give them the stock, so we have to use a temporary account called common stock dividends distributable. It's almost theirs. We can't quite give it to them. And that's going to be at the par value of $75,000. So because my debit doesn't equal my credit, I need that PIK account in excess of par, and that's where the 225,000 is coming from. 300,000 minus the 75,000, and there we go. So that's your first journal entry. That is when we declare a stock dividend. Okay? When we eventually, make good on the stock we're giving them, that's when we actually distribute the stock dividend. So we'll call this journal entry number 2, and we'll call it the distribution of the stock dividend. And basically what's happening here, I like to use this expression when I'm teaching my classes. I like to say whenever we get rid of a liability or we get rid of anything that ends in bull, we debit that bull. So to get rid of the bull, in this case distributable, you want to close anything down, you want to do the opposite of what's there. So we want to get rid of the bull by debiting the common stock dividends distributable. And that's going to be for the 75,000. And now that we've gotten rid of the obligation, the reason why you're getting rid of the obligation is because you're actually giving them the stock. So we're going to credit common stock. And remember, common stock is always credited for the par value. The common stock dividends distributable was a temporary version of the common stock. That's why that one had to be recorded at par as well. Okay, so those are the two journal entries that are connected with a small stock dividend. So to make a long story short, what's happening here is that we had to use market value to determine the initial debit to retain earnings, because we know we've got to credit the stock at par, and because the retained earnings was greater than the par, and it should always be that way, because the market is typically always higher than the par value. Because if you recall from a previous video, remember that it's illegal to sell stock below par, so companies kind of pick a super low par value right out of the chute so that they don't run into that legality issue. So the chances of your market price ever going below par, if that ever happens, your company's in trouble. So market should always be higher than the par. So because of that, we're going to require the PIK account, and that PIK account makes up the difference between your market and your par. So notice we credited common stock dividends distributable for the 75,000, and then when it was time to distribute it, we got rid of the bull and we actually credited the common stock. Okay, so if you look at the stockholders equity section that I have up here, you will notice that I have a before small stock dividend and then after small stock dividend. So we need to do some corrections here. First off, with the paid-in capital, you will notice I have 100,000 shares of $5 par. Well, we no longer have 100,000 shares outstanding. It's 115,000, right? Because didn't we just give these stockholders an extra 15,000 shares? So if we do that math now, we got 115,000 multiplied by the $5. That's going to be $575,000 worth of common stock. Okay, so when we credited common stock, we literally increased it by 75,000. So I could have just said, can I just take 500,000 and add $75,000 to it? Sure, and we get the same answer, 575. We also credited PIK for 225. So we went from 400 to an additional 225,000. So the original 400,000 plus the 225. So that brings us up to $625,000. Okay. The stock dividends distributable, if I had done this immediately after journal entry number 1, then I would have a number here. But since basically the common stock dividend distributable canceled each other out, I don't need to put that in there. So we can leave that one out of there. All right, so in the meantime, your total PIK, we add these two numbers together. That's going to be 1,000,002. As far as your retained earnings goes, okay, your retained earnings, if you remember this first entry, we debited retained earnings. So whenever you debit an equity account, it goes down. So we started out with 600,000 and we're subtracting the 300,000 that we debited retained earnings for, and look at the similarities between before and small. Okay, before the small stock dividend and after the small stock dividend. Notice that the total stockholders equity is the same. It's 1,000,005, just like it was before. So when you have a small stock dividend, there is no impact on the total stockholders equity. But look what happened. Your stock went up from 900 up to 1,200. So your stock went up by 300,000 and your equity went down, your retained earnings went down by 300,000. So it's basically we've shifted the components within the stockholders equity section. We beefed up the stock section and we took it away from the retained earnings section. Basically, it ends up being a wash because if you notice the total is still 1,000,005 and the total here is 1,000,005. Okay, so the bottom line is that a stock dividend does not impact total stockholders equity. However, it increases your paid-in capital and decreases the retained earnings. So that's what you want to remember when it comes to a stock dividend. In the previous video, we talked about a cash dividend. A cash dividend makes your stockholders' equity go down thanks to retained earnings going down, and cash goes down. So both sides of the balance sheet are impacted when you have a cash dividend. But when you have a stock dividend, your cash, your liabilities are unaffected. The only thing that's impacted is your equity section. And what happens in stockholders' equity is your stock stuff goes up, your retained earnings stuff goes down, but the total remains the same. Okay, so let's just write conclusion here. All right, so hopefully that was understandable. And oops, don't need to do that. My mouse is sticking here. Here we go. There we go. Okay. Let's now take a look at what happens if we have a large stock dividend. Now, a large stock dividend, if you remember from up here, is 25% or greater. We still have common stock going up and retained earnings going down. So we will see yet again our total stockholders' equity not changing, but the components within will change. Your stock will go up, your retained earnings will go down. However, if you notice, there's no PIK involved with a large stock dividend, because when we do a large stock dividend, retained earnings gets debited for the par instead of the market. So that means our debit's going to be recorded at par and our credit's going to be recorded at par. There's no need for PIK because there's no excess of par. So let's look at the same example. Let me scroll down here. And we're going to look at the same scenario as we did earlier. And with one little modification. Notice instead of a 15% stock dividend, we now have a 30% stock dividend. Okay? So let's do the math. So the math involved is we're going to take the, now this is assuming we never had the small, so we're right back to the original data. So we're going to take 100,000 shares and we're going to multiply it by 30% this time. And if we do that, we get $30,000. Oops, my 100,000 and not a. Let's try that one more time. 100,000 multiplied by 30%. There we go. There's our $30,000. So 30,000 shares. So these are the extra shares that are going into the stockholder's pocket. So we're giving them a 30% stock dividend, which equates into 30,000 extra shares. Okay? So what we're going to do now with that, and let me put a box around the stockholders' equity like I did last time, so that we don't confuse the math with the stuff that's already in place. Okay, so we're going to take the 30,000 shares and we're going to do 3 multiplications with that 30,000. Actually, just 2 this time. So we need to figure out our retained earnings and we need to figure out our stock. Remember, the stock is at par, and because this is a large stock dividend, how do I know it's large? Because of the 30%. So if they declared a 30% stock dividend, that's what tells us it's a large stock dividend. So let's do the same thing we did last time. Okay, so that tells us it's a large stock dividend, just from that point of view alone. All right. So back to the math. So we've got 30,000 extra shares. And what we're going to do is we're going to multiply the 30,000 by the par value. And the par is $5. Oops. So if we do that math, 30,000 times $5, and that's $150,000. And believe it or not, the exact same thing is going to be done for the stock. So basically, what is going on here? I'm just going to copy, paste it, and also copy that. So $150,000 is going to get debited to retained earnings, and $150,000 is going to get credited to the stock account. Okay, so here we go again. Journal entry number 1. In journal entry number 1, what are we doing? We're declaring the dividend. And I'll make sure it's clear this time, declaring a large stock dividend. And the journal entry is you are going to debit retained earnings, and you're debiting it for $150,000, and you're going to credit common stock dividends. You remember that? Remember that extra word that's here? Distributable. And that's for $150,000. Notice no PIK. That's because we use par for the debit and the credit. Last time we used the market value for the debit, and that caused the debit to be larger than the credit, therefore we needed the PIK account. So that's your first journal entry. Journal entry number 2, get rid of the bull. Let's pay out, in essence, or distribute the actual dividend. So journal entry number 2, we're going to distribute the large stock dividend. And how do you do that? Well, you get rid of the bull. So debit your common stock, dividends, distributable, for that 150,000. And guess what you're going to credit? What are we actually giving them? A large stock dividend. So we're going to credit common stock. So that was the whole point. Remember, we are giving them more stock. We didn't have, let's say, good enough cash flow to give them a cash dividend. So remember, a stock dividend is kind of more like a pacifier, kind of appeases the stockholders. They're getting something. But this dividend could eventually, excuse the pun, could pay dividends, could pay off in the long run, because now the people that own the stock now have more stock in their possession. In fact, they had 100,000, now they have 130,000 shares. So let's figure out the new stockholders equity section. So instead of 100,000 shares times $5, we now have 130,000 shares times $5, and that's 650,000. Okay. Notice that the PIK remains the same. Okay, but our retained earnings needs to go down by 150, since that's the par value. So what we need to do is we need to figure out, we had 600,000. We're going to subtract 150 and look at the value of my stockholders' equity. The value of my stockholders' equity is still the same at 1,500, or 1,000,005. Okay, so your total stockholders' equity does not change as we established before. The difference here is that we did not have the need for PIK. So the only thing that changed was the value of the common stock. The common stock went from 100,000 shares at $5 a share. Now there's 130,000 shares out there at $5 a share. So the retained earnings was impacted by the value of the par. whereas in the previous example, the retained earnings went down by the value of the market. Okay, so we had 575 as common stock, and then an additional amount went into PIC. So we saw a change of 300,000 from pre-stock dividend to post, and then a decrease in retained earnings by 300,000. Those 300,000s offset each other, left us with 1,500,000. In this large stock dividend, the par value was impacted, and the stock account went up by 150, and retained earnings went down by 150. Okay, so the same conclusion that we had before is the same conclusion we have again. And that is stock dividend does not impact total stockholders' equity. However, it increases paid-in capital and decreases in retained earnings. Well, we need to change a little bit of that. It decreases only the retained earnings. So stock dividend does not impact total stockholders' equity. However, we'll say here, however, let's say common stock increases and there is a decrease in retained earnings. So the components within the stockholders' equity kind of change amounts. One goes up, one goes down, but they're offset by the same amount. Okay? And again, notice that the total stockholders' equity remains the same. So I hope this was helpful. Tried to do some transactions right in real time with you here so you can see how things were being done. And hopefully there'll be some more videos coming after this. But I hope you've enjoyed all of these accounting videos to date. All right, that's it for me for right now. Again, this is Dr. Sam Lansafami. Appreciate your time. I hope that these videos are helping you understand accounting. All right, take it easy, everybody. Bye-bye.